Okay, so we've established then that we obviously need to know how to consolidate a subsidiary. We need to know how to equity account for an associate or a JV. All right, so what is it that means? Right, procedurally, what is it that we have to go about? And like I said to you, guidance is given. So I could say, if I was lecturing with a residential university, I'd say, if you want to know how to do the first thing, go and read IFRS 10. And if you want to know how to do the second thing, go and read IAS 28. Lecture over. If there are any questions, come and see me in my office, and I'll never be there. Okay, I won't do that to you. All right, so what does it mean to consolidate a subsidiary? Well, simply this. All right, if you think about it, to consolidate a subsidiary or to bring the two together, we're going to be starting off at any point in time, like I said, with the parent and the subsidiary. And you'll understand that they have two separate sets of financial statements, don't they? Each one has its own separates. And in those separates, in terms of full-blown IFRS, they will have accounted for their assets, all different assets, debtors, PP&E, investment properties, financial instruments, not so. Right? They would have accounted for their liabilities. They would have accounted for their incomes in profit or loss, revenue, interest income, whatever the case may be, dividend income. They will have accounted for their expenses in profit or loss, and there'll be lots of them: cost of sales, selling expenses, admin expenses, depreciation, etc. They would have accounted for their other comprehensive income items, which we will do plenty of, okay, during the course of this course: remeasurements of PP&E, actuarial gains and losses for defined benefit plans, right? There's a whole list of them. And they would have accounted for their equity transactions, all right? In accounts 1, that would have just share capital, not so. In accounts 2, you probably learned about preference share capital. Okay, dividends, that's an equity transaction, right? We get to accounts 4, we'll look at share-based payments, okay, an equity transaction. Right, in accounts 3, I think at some point, you looked at debentures that had an equity component. Right, so you'll appreciate all of that. They're going to have all of these accounts, and let's visualize that. That's a trial balance, okay? So they will have all of these accounts on their trial balance accounted for in terms of IFRS. They told them what adjustments to make. So, I don't know, in a big company, that trial balance is, seriously, it's like there's probably 1,000 accounts there, okay? And then from that, we're going to group everything and put them in the correct financial statements, okay? And all it means to consolidate, people, is to add the two together. That's all it means. So what we're going to be doing, if you like, is preparing these consolidated financial statements, and all we do here is we add the P and the S column together. So always, for those of you that have worked in Excel, which is just about all of you, okay, I'm going to say, it's just a formula. Okay, you have, in column A, you have all your P accounts. In column B, you have all of your S accounts, and then you create a formula, add A plus B. That's it. That's what it means to consolidate. And if you appreciate that all of this here balances in compliance with IFRS, you would probably conclude that all of that balances and complies with IFRS. Right. The problem is it doesn't. Right. So there's a whole lot of group procedures or consolidating procedures that we've got to go through to make that final blue column comply with IFRS. And what we do in getting from P plus S to IFRS compliant financial statements is we make a whole lot of adjustments. Okay, and these adjustments we call we call them pro forma adjustments or pro forma journal entries. The word pro forma just means they're not real. They're like Mickey Mouse entries. All right. There's no entry that's being processed in the records of P or S. This first column here for P, okay, that's P's financial statements. They're IFRS compliant, they're Companies Act compliant. You're not allowed to touch them now. Eh? All right. Same with S. You're not allowed to touch them. Right. But what you've got to do is add P plus S together. And for that to result in an IFRS compliant set of financial statements, we're either going to have to make some plus adjustments or some minus adjustments, as the case may be. All right. And if you ever do this in practice, you actually do it in Excel, truth be told. Okay. And you'll find that you'll have a different column here for every adjustment that you make. All right. Just to jump into a couple of the adjustments, just the simplest ones that you could think about. All right. The most obvious one is, you'll appreciate, because you've discussed it already, that included in the assets of P, they have got an asset called investment in S. That's a fact. You go back to that entry I passed just now. When P bought S, what did they do? They went debit investment, credit bank, not so. All right. People, that investment, right, needs to get wiped out of the picture. Because if you think about it, if you've got this investment as an asset over here, all right, and you add P and S together, you'll appreciate it's in that total on the right, isn't it? But also in the total on the right, what else have you got here? You've got every one of S's assets and liabilities. Can you see that the value of S has been accounted for twice in that far right-hand column? It's been accounted for as a one-line investment, which represents its value of sorts. Okay, and then where's the other value of S? In all of S's assets and liabilities, it's there twice. Can you see that that investment needs to disappear? All right, and it does. And that investment, you'll learn to make it disappear in terms of IFRS 3. Right. Possibly a simpler one is, because it happens often in practice, is that you get one company loaning money to another. So let's assume, and normally it's the parent loans money to the subsidiary. All right, and you just do accounts one. This is going to get more complex as we go, but just to get the principles right. Okay, if A or if P loaned money to S, you'll agree that in these assets there's a loan receivable, isn't it? If you loan somebody money, accounts 101, what's the entry do you pass? You go debit, loan, receivable, credit, bank, not so. All right. And by the same token, if someone loans you money, what entry do you pass? Debit, bank, credit, loan payable. So these guys have got a loan payable in their liabilities. When you add the two, P plus S, together, you'll appreciate that included in those assets is the loan receivable. Included in these liabilities is the loan payable. You can't have that. Simple picture is this. If we have P and S, we said P's got a loan payable, they've got a loan receivable. All right, a loan receivable is an asset. Why is it an asset? Because there's going to be an inflow of benefits, not so. Cash is going to flow from outside of P into P. That makes it an asset. Likewise, there's a liability we're saying in S. What makes it a liability? The definition of a liability is a present obligation, which will result in the outflow of economic benefits. Cash is going to go out of S and it's going to go to P. The question I'm asking, though, is I'm not looking at P and S as separate entities. I'm looking at the group, aren't I? Then the question I've got to ask is, how much is flowing from inside the group to outside the group, and how much is flowing from outside the group to inside the group? Nothing. So from a group perspective, there's no future economic benefits. There's no future outflow. So what do? Leave it like that because it's wrong? No, you can't leave it like that because it is wrong. So what do you got to do? Correct it. How do you correct it? Can we just go here and quick myself some Tipex. Can we go out there and Tipex out those figures and just make them correct? Obvious answer to that is no, you can't. Okay, because you can't use Tipex in Excel. All right. So what you've got to do is you've got to make an adjustment, and you've got to record that adjustment. You can't expect people just to, you need some sort of trail as to the adjustment that you made. So what you do is you have, like I said, this list of pro forma entries that you process, and the pro forma entry there is going to be to say, listen, I need to get rid of the loan receivable. How do you get rid of a loan receivable? You debit the loan receivable in SFP. How do you get rid of a loan payable? You debit the loan payable in SFP. Okay. So if you debit loan payable, what's that going to do? It's going to make your loan payable, your liabilities, smaller. If you credit a loan receivable, it's going to make you smaller. And now when you do your formula, which is going to be to add up all of that, I think you'll appreciate the loan receivable is no longer in there, and the loan payable is no longer in there. So those are very simple pro forma adjustments. But I think what it does do is it illustrates to you that we do need to eliminate these intercompany transactions. Okay, so the fact that there have been intercompany transactions does have an impact on the separate figures, not so. And by virtue of the fact they're in the separate figures, when you add P plus S together, they find their way into the consolidated figures. And to the extent that those consolidated figures need manipulation, what do we need to do? Basically, we need to process a pro forma adjustment for every one of those manipulations. All right. And you will see that's what I've got in the material for you here. So if you look at that material over there, that is the bare bones basics. And please understand this. What I've got in there is the basics. All right. So those are the basic adjustments that you need to make. All right. In the context of CTA, all right, if they ask any of that stuff that you see in that table of contents, please understand, I would expect you to get 100% for that. Okay. Because you better believe there are going to be other adjustments that are a damn sight more difficult than those. Right. But that's the basics that you need to know. We're going to run through that in a minute. Okay. But before I do that, I'll get back to the point I was making, and that is, what's the difference between consolidation and equity accounting? Right. So consolidation is literally take the two trial balances and bring them into one. All right. And then you end up with a consolidated trial balance, if you like. And then in accounts one, we all learned to prepare financial statements of a TB, didn't we? Okay. So now you've got your correct consolidated figure. Now you can go and prepare a set of IFRS compliant financial statements of those figures. All right. That's the consolidations procedure. So what does it mean to equity account? I think you'll appreciate that in the separate financial statements of the parent, we're going to have assets, liabilities, incomes, expenses, OCI items, and equity items. All right. For the associate or JV, we've spoken about it. These guys also have separate financial statements with assets, liabilities, income, expenses, OCI, and equity accounts. And to consolidate, we added the two together line by line. We said the parent is in control, therefore they're in control of the revenue, the cost of sales, the PPE, the debtors, the creditors. So how do we show that control? We simply said, well then, line by line, add the two together. And this over here is what the parent is in control of. And we show the financials, we show that to the users as the consolidated financial statements. And in those consolidated financial statements is everything, every line item that is under the control of the parent. Because if the parent controls the sub, the parent controls everything in the sub, not so. This is not control. This is what we refer to as either significant influence or joint control. It's less than control. So what we want to end up with is a similar result, not the same result. All right. We want to end up accounting for the same value but in a different way. So if you go back to that picture and you say, what ended up in the statement of financial position of the group? It was every asset and every liability, not so, line by line. So what we're going to do here is a similar thing, but different. So what we're going to do is we're going to take the assets and liabilities in SFP. We're going to take the assets and liabilities of the ASOC or JV, and we're going to bring them into the group, or we're going to bring them into the parent. All right. Not all of them, just our percentage. And not line by line, just on one line. So you literally take the asset value, the net asset value of your ASOC or JV, and we bring that into the group, okay, on one line, and we call it the name investment in associate or investment in JV. So what it represents, okay, is our percentage of the assets minus liabilities. Same thing with income and expenses. In the sub, you would have had 100% of every income and every expense, line by line. In the ASOC or JV, you're going to have just your percentage, and you're going to account for it on one line. And give it a name. I'm not too pedantic about the name. UNISA will call that share of profit from associate, or share of profit from joint venture. What does it represent? All the income, all the expenses, correctly accounted for in terms of IFRS of the ASOC or the JV, my share of that on one line. And we will account for my percentage of the other comprehensive income on one line. And then if you'll appreciate, if you then prepare a separate statement of changes in equity, where does the profit end up? Your share ends up in retained earnings. Where does the reval surplus end up? Your share ends up in. So in other words, for equity, we're going to end up with our percentage. Okay, and it'll be in the right place. All right, so our percentage of all the different equity reserves, they'll end up in the correct place. Okay. So that's just what I wanted to try and just show you to demonstrate the difference between the two methods of accounting. It is very interesting to note that the value that we end up accounting for is exactly the same. Because there's one more entry that we process in the consolidation environment. And that is to attribute to the other shareholders their share of the profits and the other comprehensive income. Because if you look at the picture I drew over there, I consolidated 100% of every asset, every liability, every income, every expense. If you've got control, does that mean you own 100%? The answer is no. You could own 60%, you could own 70%. You'll come across, now that we're in postgrad, you'll come across scenarios where, I kid you not, you could own 0% and have control. All right. The question was, do you have control? Yes or no? Answer yes, consolidate. What does that mean? Add everything together. 100% with 100%. Are we clear? And then, if you don't own 100%, right, we process 2 entries you're going to be processing for me in this regard. Okay. The one is debit profit or loss and credit SCE, statement of changes in equity. I need just to imagine what happens. Now you need to think back to like accounts 1 bookkeeping here. All right. You've got all the income, all the expenses of H&S at 100% in your statement of profit or loss, not so. So that bottom line you see there, profit for the year, it's 100% of the sub, not so. But do we get to keep 100? No. So how are you going to give, you got to give 100, you got to give something away, haven't you? So you got to make that profit smaller. Hence the debit to profit or loss. But give it a name. Okay. And the name we give it is non-controlling interests share of profit. So we bring on 100% of the profit, and then we go, hang on a second, we don't get to keep all that profit, so we process just one little line entry where we give them their share. All right, so please, if you want to make a fool of yourself in an exam, okay, then go and do this. Give me a statement of profit or loss where you own an 80% sub, and you go revenue, all of H plus 80% of the sub. Okay, that they should like take you there and then put you back in second year and say, right, now start again. All right, when you consolidate, we've got control. Okay, control is absolute. We've got control of all the sales. Okay, we don't go, oh, I don't control this sale because that's the other guys, but I do. No, you control all the sales, don't you? But of the money that we get from those sales, do we get to keep it all? No. So of the net profit, when all is said and done, we attribute to NCI a share of the profit. And it sits there. It's a separate line item in the statement of profit or loss called NCI share of profit. And it makes the profit a bit smaller, leaving the group with a bit less, doesn't it? All right. And the other side of the entry? Okay, well, if you think about it, ordinarily, where would your profit end up in the statement of changes in equity? In retained earnings, not so. Right. Now, some of that profit isn't our retained earnings. So where's it got to end up? Obviously not in the retained earnings column. So you know what you do? You start up a separate column for the NCI. And in that separate column, that's where their retained earnings goes. That's where their share capital is going to go. That's where their preference share capital is going to go. That's where their mark-to-market reserve, reval surplus, actuarial gain, any reserve which belongs to NCI, let's put it that way, is going to end up in that NCI column. But understand this, you've got to do it manually, because your starting point was all of H plus all of S, not so. So what have we got to do? Give NCI a share. That doesn't just apply to profit or loss, it also applies to other comprehensive income, and sometimes that's an easy calculation, sometimes that's an outrageously difficult calculation. Okay. So just to summarize then, when we consolidate for all assets and liabilities, it's H plus S. And please, 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 every year, okay, I don't mark for UNISA anymore, but every year when I used to mark for UNISA, I used to see students going H plus 80% of S. It's not. It's all of H plus all of S, line by line. Okay. Income and expenses, H plus S. OCI, H plus S. Owner's equity, H plus S. And then, in a separate entry, to the extent that any of that needs to be manipulated, what do? We give NCI their percentage. So what do we end up with then? Our share. You end up with your share, but you account for it, all of H plus all of S, give the NCI their share. Okay, and then the equity accounting, how is that any different? Okay, well, for assets and liabilities, income and expenses, OCI, owner's equity, we account for H. Line by line, we account for H. So if you were to do the group, that big spreadsheet that we do for group accounting, okay, you're going to find that when we equity account, there is no column for the JV or associate, not so. Instead, what we do is we bring on a percentage of the assets and liabilities on one line, a percentage of the income and expenses on one line, a percentage of the OCI on one line, and then that will result in a percentage of the equity in the different reserves that you see on the statement of changes in equity. Okay, so that's the principle. That is where it is that we've got to get to. All right.